In the next 10 minutes, we will take a look at what stocks are, what the stock market is, how they are connected, how you can make money with stocks in the stock market, and what the risks are. We will also look at why so many people are afraid of investing. This video is especially for people who have never dealt with this topic before. My name's Sean, and here on the channel, I explain different financial products, helpful strategy, and insights that the financial world has to offer. Let's get started. Stocks are shares in a company, and therefore shares in the company's profits. These shares are traded on the stock market. Stocks that are traded on the stock market have a stock price, which is determined by supply and demand. If many people think that a company has bright prospects and will produce more profits in the future, they want to buy the stock to benefit from the profits. When many people want to buy something, the price naturally rises. This is exactly how it works with stocks. However, if many people want to sell a stock, the price or stock price will fall. So to summarize one more time, a stock is a share in a company. When many people want to buy this share, the price rises. When many want to sell it, the price falls. And with that, we come to the next topic, the stock market. The stock market is nothing more than a marketplace. Here, people who want to buy stocks meet those who want to sell stocks. The stock market's job is simply to bring these two groups together so buyers and sellers of a stock can agree on a stock price. This doesn't happen directly from person to person, but is now carried out automatically via computer systems. The stock market's task is to determine the price of stocks, which is based on supply, those who want to sell, and demand, those who want to buy. Now, how can you make money with stocks on the stock market? There are two ways to make money with stocks. First, through capital gains. If you buy a stock at a low price, hold it for a while, wait for the price to rise, and then sell it, you realize a capital gain. The second way to make money with stocks is by participating in the company's profits. When a company makes a profit, it keeps part of it to finance future projects and improve its capital position, and distributes the other part to its shareholders. This distribution is called a dividend. Now, this whole thing sounds pretty nice. So why are so many people afraid to invest their money in stocks and the stock market? The main reason is often bad personal experiences with investments or bad experiences from friends and acquaintances. Additionally, the media often reports horror stories of people who have lost all their money and of financial crises that keep repeating themselves. One example of such a horror story where many people got burned and then never touched stocks again is Wirecard. The Wirecard stock was marketed as the stock of secure payments and risk management, and many people, especially Germans, added the stock to their portfolios. Afterwards, there was a massive scandal of 1.9 billion euros that was found missing in a special audit. It was a huge case of fraud and embezzlement, with the CEO getting arrested and the COO disappearing, and many people lost a lot of money and never invested in stocks again. So these horror stories are actually based in reality. Of course, investing in stocks and the stock market carries risks. Now, a great way to reduce your risk in life is, of course, you guessed it, liking and subscribing to the channel. Please. So, what are then the risks of investing in stocks? Basically, there are two types of risk. First, there is market risk, which affects the entire market. For example, if unemployment is high and people aren't earning much money, they can't spend as much and companies generally don't perform well. Then there's the second type of risk, the company-specific risk. This is a risk that each company carries individually. For example, take the VW emissions scandal. It was a risk that only affected Volkswagen. After the scandal became public, Volkswagen's future prospects worsened significantly. There were more investors wanting to sell Volkswagen stock than to buy it, and the price dropped. However, there are ways of risk spreading, also called diversification, to reduce company-specific risk to a minimum. You diversify your risk, or spread it, when you don't invest in just one stock or one company's share, but in many different stocks and therefore in many different companies. For example, if you want to invest broadly in the US, you can use an index as a guide. The US index, for instance, is the S&P 500, which represents the 500 largest publicly traded companies in the US. If you invest broadly in the S&P, you have significantly reduced the company-specific risk of any single company. You are investing in 500 companies at the same time, which are usually active in various industries and regions worldwide. So you no longer benefit from the performance of just one company, but from the overall economy. However, when diversifying, you should take it a step further and not just invest in the US, but ideally worldwide across different regions, countries, industries, currencies, and with a healthy mix of small, medium, and large companies. To achieve maximum diversification, you often need to invest in hundreds or even thousands of companies. You, of course, don't have to buy all these individual stocks yourself. There are so-called funds or investment funds that do this work for you. And here we come to two different approaches to investing in the stock market. First, there's active investing, where you consciously select companies and try to evaluate them with the goal of finding companies that will have rising stock prices in the future. The second approach is called passive investing. The goal here is to minimize risk by investing in many companies worldwide across different industries. A major advantage of passive investing compared to active investing is that it is significantly less time consuming and in many cases much more successful. But why does it even make sense to invest your money in stocks instead of simply putting it in a savings account at a bank? First of all, in the past, you have always earned less interest on savings account or similar savings vehicles such as money market accounts or fixed term deposits than the inflation rate. As a result, your money loses value every year and your purchasing power decreases. However, if you invest broadly in many different stocks over the long term, you benefit from economic growth. In the long run, this has always been positive, even though there have been crises in the short term and there will continue to be crises in the future. As you can see here, there are large fluctuations in the short term, but if we look at it over a longer period, we can see that there has been consistent growth. Our portrayal of stocks and the stock market is, of course, very simplified. For example, not every stock company is traded on the stock exchange, and there are other financial products such as various derivatives or bonds that are traded on stock exchanges. If you are interested in learning more about these topics, you can find a list of videos in the description where we go deeper into some of the topics mentioned in this video. And if you're interested in passive investing, then we've also made a video course that you can find here. If you have any questions or thoughts, post them in the comments, and if you enjoyed this video, then you might want to check out this other video over here, which is about derivatives, which I've also linked in the description below. Thanks so much for watching, have a great day, and I'll see you in the next video.